what is a traditional mortgage? For us investors, if you have a 30-year mortgage and you're paying principal, that means that your tenant is paying down your mortgage. And that's one of the beauties of real estate. You're building equity, but you're not paying it. The tenant is. A traditional investment mortgage is one where you're going to have to put down 20% and you're going to pay 1% higher than what the market is. What are DSCR loans, which is debt service coverage ratio loans? Basically, that means that the lender is lending you money based on the income of the property. The interest rate you qualify for, and here's a pro tip, is not, and probably most of the time, is not what these brokers or banks give you. Hey guys, and welcome to the Real Estate Doctor podcast, where I am here to educate, inspire, and sometimes entertain you. So today I wanted to talk briefly on conventional mortgage loans. You know, there's a lot of technicalities with conventional mortgages, and sometimes we're talking about hard money or we're talking about private money, you know, but what about like a good old regular 30-year investor mortgage or something like that? You know, so if you're interested in private money and raising private money, we've done a podcast on that and we'll put the link below, but this one is on traditional mortgages only. So what is a traditional mortgage? So first off, a traditional mortgage, as everybody thinks about it in the United States, is a 30-year mortgage. Now, the United States is the only country that has a 30-year mortgage, and the only reason we do is because Fannie Mae and Freddie Mac back that. If you really think about it, most banks don't want a 30-year mortgage because rates go up and down, and if they go up, they want to be able to raise them, and if they go down, they want to keep them the same, actually. So a lot of regular loans in other countries, and we do have these in the United States, are like what they call 5-1 ARMs or 3-1 ARMs. Basically, they're, you know, a fixed rate for 3 years or 5 years or 7 years, and then it readjusts itself. It might have a amortization, which what does amortization mean? That means that you're paying also principal, but the interest rate is only fixed for a period of time. So a traditional normal loan in the United States is a 30-year fixed rate mortgage where you pay principal and interest. So for us investors, you know, if you have a 30-year mortgage and you're paying principal, that means that your tenant is paying down your mortgage. And that's one of the beauties of real estate, is that you're building equity, but you're not paying it. The tenant is. And I get this all the time too. People are like, oh, interest rates are so high. You know, if you can rent a property out and it cash flows and the interest rate is high, what do you care? The tenant is paying that interest and you're still making principal payments. You still have cash flow and you are dating the rate and marrying the house. That's something you guys should always remember. Date the rate, marry the house. So if I don't like today's interest rates, then I can always, if they go down, and if you think they're going to go down, I can always refinance later. Because right now we're in a market where everybody's like, oh, I'm waiting. Well, you can't wait because, you know, what's going to happen when the rates actually do come down? There's so many people on the sidelines that want to get in. They're going to come in and the prices are going to go up. So you should buy the cheaper house now with the higher interest rate. And as people, if they lower interest rates, which I think they probably will too, and if they don't do it in the short term, you know, we'll be in some economic recession or something in the future. It could be 5 years, 7 years. They're going to lower rates. So when they lower those rates, you can refinance, and now you'll make more money on the same house than what you did originally. So the beauty is buy that house cheap now, and you can change the rate later. So date the rate and marry the house. Now, a normal 30-year mortgage, normally in the U.S. for an investor. Now, I'm not talking about a house you're going to move into. Let's talk about different type of mortgage rates. So you have a 30-year mortgage rate, and you can look these up. I actually follow some kind of mortgage rate thing on Instagram. It's really nice. They update every day what the mortgage rates are. But, you know, you have a 30-year mortgage. You have a 15-year mortgage. Usually that interest rate's a little bit less. You have an FHA mortgage that is usually less. And so you have all these different types. Now, when you hear what the interest rate is out there on the, the news and things like that, well, if you're hearing that interest rates are 6%, usually for a 30-year mortgage, that is for a homeowner. As an investor, you're almost always going to pay at least 1% more. So if interest rates are out there and they're 6% or 7%, you just got to add 1. You're an investor. It's not a homeowner property, and you have to pay more. Now, you can buy, especially if you're going to buy a property in an LLC, you can buy an investment property in your personal name, and I'm not going to get into the details of whether that makes sense liability-wise or not, but there's a lot of people that do that to get a lower interest rate. So if you buy a property in your personal name, even an investment property, you will get a lower than an LLC interest rate. So be knowledgeable that the interest rates you see out there are for buying a house that you're going to live in. You will pay a little bit more if you buy it in your personal name, but it's an investment property, and you will pay about a point more, 1% more, if you buy it in an LLC. Now, that is if your credit is kind of par for the course. So if your credit is not as good, then you're going to pay a higher interest rate. If your credit is great, then you might pay a lower interest rate, but good luck seeing that. So a traditional investment mortgage, I would say, is one where you're going to have to put down 20%. So 20 or 25%, but 20% is kind of common right now. And you're going to pay 1% higher than what the market is. So if the market right now is on a 30-year mortgage is 7.31% or something like that, then you're going to pay 8.31%. And I'm sure for a lot of you investors, like, oh my God, or prospective investors, because if you're an investor, you know, right? So first off, why get a mortgage? Well, you can get a mortgage because if you're buying a property, and I'll use a $100,000 example, and you can buy them all over the country. If you're buying a property that's done and rented for $100,000, instead of paying $100,000 cash, you're only going to pay $20,000, 20% down, and you finance the rest. And that gives you leverage, and that gives you an asset, a $100,000 asset that you control that's going up in value over time. And your return on investment, which we talked about in the last podcast, is based on the $20,000 you put down. So a lot of investors get these traditional 30-year mortgages and put 20% down, and their return on investment is very good. And they might have, the beauty of real estate is you don't have to quit your job to do real estate. So you might be a lawyer, and on the side, you are buying real estate and putting 20% down with the excess savings that you have. So that's a traditional mortgage. Now, what happens, it's a fixed rate, 30-year principal and interest. Now, if you don't put 20% down on a mortgage, like maybe you got a special mortgage, sometimes a lender will ask you to escrow, which basically means they want in your mortgage payment to be principal, interest, taxes, and insurance. That's also called PITI. So for investors, most of the time that does not happen. But if you don't put 20% down, you also are subject to another type of fee, which is called PMI, which is PMI insurance. So if you're buying your personal home and you put down 10%, you are going to be subject to this PMI insurance, which is a lot of money, and it stays there until you have 20% equity in the home. And here's a pro tip for you. The bank's not going to call you and say, hey, by the way, we think that you have 20% equity in your home. If you know your properties went up in value and you have 20% equity in your home, you can call the bank and say, hey, I want to get rid of this PMI. So pro tip on the PMI, but PMI really doesn't apply for us investors most of the time. Now, you're buying a house and you're going to get a loan. You got a decent credit score. You get an interest rate of 8.1%. It's a 30-year mortgage. And the lender sends you all these different disclosures, and you don't know what all these things mean. So let me tell you like a couple common things that are happening in the market. So right now, especially for investors, they are putting what's called prepayment penalties on a lot of loans. Now, what that means is if you date the rate and the rate goes down in the next year, and usually these prepayments, I've seen them as high as 5 years and 5% per year. So it may say prepayment 5, or a 5 and it goes down. So in the first year, it's 5, 4, 3, 2, 1. Now, what is 5, 4, 3, 2, 1? That's the penalty for refinancing. So basically, these lenders are saying, listen, we don't make any money if you don't keep the loan with us. So if you go and change the loan, we need to make some money. So I hate prepayment penalties, absolutely hate them. And if you can negotiate them out of your deal, and the answer is always no until you ask, then negotiate them out. I have not seen many people successfully negotiate them totally out right now in the current market, but I have seen where you get a 3-year prepayment penalty where you can get 3-2-1. So basically it's 3% in the first year, 2% in the second, 1% in the third year. So, let's say you get a $100,000 loan and you have a 3-2-1 prepayment. That means if you refinance in the first year, you got to pay a $2,000 fee to get out of the loan. So be mindful. Those prepayment penalties will sneak up on you. If the market changes and the rates go to, 5% like that, and you want to refinance, you can't refinance if you're paying you're going to do the math. You're going to see like, hey, does it make sense to refinance anyway and pay this penalty? But if you can negotiate those out, it's something that you really want to pay attention to. So how about the interest rate they quote me for? So, Doc, you just said that, I'm an investor and the market right now is 7% and they quoted me 9%. That's 2% over. And, they have points and origination fees and all these other things. So let me just tell you that the interest rate you qualify for, and here's a pro tip, is not, and probably most of the time, is not what these brokers or banks give you. So if you qualify for 8%, they may show you 9%. And the reason they do that is because they get paid on the back end from the actual bank for getting you to take a higher rate. That's actually called a yield spread premium. It's kind of a dirty little secret in the business. So if you see that you're getting a 9% rate and you don't see any points, or they're always in relation to what you're paying as a fee to a broker or a bank. Now, you can do the opposite and you can pay down the rate. So like, let's say you have you're quoted an 8% rate. They may say, well, if you pay a point or 2 points, we'll lower you to 7%, right? And so sometimes that makes sense to do. So let me just talk about that. You have to do the math. If you're going to keep a mortgage for 30 years and you can buy down the rate from 8 to 7, pretty much you're definitely going to make out by paying now and having a lower rate for 30 years. Now, pro tip, you're probably never going to keep this mortgage for 30 years. One, it may go, the interest rates may go down. And if you think that they're going to go down, you should never buy down the rate because you think the rate's going to go down anyway. You'll just refinance when it goes down. Now, if we're in a high interest rate environment or you think the interest rates could go up, you might want to buy down the rate. But you have to do the math. Now, I always do that math based on 7 years. Most people stay in a house for 7 years and most people stay in a mortgage for 7 years. So I do the math. Will I save whatever I'm paying now over 7 years in interest if I pay it now? And if that's not the case, then I don't even entertain it. And then even if that's the case, do I think that interest rates might go down in the future? And if they will, then I'm not going to buy down the rate. I'll just wait for them to go, and I'll try to make sure I don't have too many prepayment penalties. So you can buy down the rate. And what all these people are doing is trying to give you a higher rate, and you can ask, is that par? Are you giving me par? And they might be like, no. Well, we're going to have to, if we give you par, we have to charge you more. And that's what they do. So make sure that you're getting the rate that you really qualify for. And that's super important. A lot of people don't know that. And, I see interest rates, investors out there getting quoted for 9.2, when really they should be in the 8s or the 7s. Now, that's your typical 30-year mortgage rates. Everybody's talking about DSCR loans. What are DSCR loans? Which is debt service coverage ratio loans. Basically, that means that the lender is lending you money based on the income of the property. Now, I see all this stuff on Instagram and TikTok where that basically means like, well, hey, you can get a no money down loan. No, you can't get a no money down loan. Theoretically you can, but they're actually just go and look up DSCR calculator and do the math, like how much more your rent has to be for it to be a no money down deal. And most of you are not finding those type of deals. Even I'm not finding those type of deals. So what a DSCR loan is not a way for you to do a no money down deal. That being said, they are powerful, and you can get those loans based on the cash flow, not based on you. And also, you can get them fairly quickly. So right now, there's a lot of competition because these have blown up. And I've actually seen these in the 7 rates as opposed to like a regular 30-year mortgage. And they're 30-year mortgages too. They're just a different variation of them. So DSCR loans are great. And another way that some people use DSCR loans or any kind of loan is they do the Burr method, which we'll put a link in the description here. We did a podcast on what the Burr method is. But the beauty of a DSCR loan is a lot of them you can refinance after 3 months, not 6 months, which it's been traditionally, and not 12 months. So basically you buy a house cash, or you use hard money or private money, and then the house is done and it's rented. It has to be rented and have income because that's how you're getting the loan. Within 3 months, you can refinance the property and take your money back. So a Burr method, basically give you a little breakdown on the Burr, is where you buy, renovate, rent, refinance, repeat. And the reason you do that is instead of putting 20% in a deal, you put up the money in the beginning, but you get it all back because you bought it right. Please check out the podcast on Burrs. You bought it right. And the loans that everybody's getting out of these loans is our DSCR loans in 3 months. You can do traditional ones in 6 months, and there's a lot of bait and switch where people will say, we can do in 3 months, but you can only get 65 or 70% loan to value. So you're not going to get the full amount of money you can get out, where if you wait 6 months, you might get 80%. Or nobody's getting 80%. They say you can get up to 80%, but then you end up getting 75%. So there's a lot of funny business that a lot of mortgage brokers and lenders do out there. So it's important for you to know a lot of these facts. So let me tell you a couple other things. We told you what yield spread premium is. Make sure you're getting the rate that you qualify for. The other thing I want to tell you about is what are points. A point is 1% of a loan. So if you get a $100,000 loan, 1 point is $1,000. 3 points is $3,000. So that's how brokers make their money, or they call them loan origination fees, or they charge you both. And then they charge you an underwriting fee, and they charge you all kinds of fees. So generally speaking, you want to try to negotiate a lot of these fees. If you're getting a conventional 30-year loan and you're paying 4 points, that's too much. You should be paying 1 or 2 points. You can go direct to the bank. You might not even have to pay any points. Now, I do like to use brokers because they do have better knowledge than we do about all the different products that are out there. And those products change all the times. And probably this will be outdated in a year. There'll be a totally different product that I think is amazing. So the 30-year mortgage for an investor, that's basically what we were talking about here in this podcast. I do want to mention that if you are foreign to the U.S., you can also get these mortgages. Sometimes you can't get as high of a loan to value. So instead of doing 20% down, you might have to put 30% down, or in a refinance, you might only get 65%. But you can get 30-year fixed mortgages if you're foreign. So you can get those too. You can still do the Burr method, and you can still invest like everybody else in the United States. However, there's very few banks. There's 4,800 banks out there, and there might be 50 out there that will really loan to foreigners, not like the foreigners that have $100 million in their bank. So wanted to break down, some of the information that you guys, when you go to get a mortgage, some of the questions that you might get, just a few other that popped in the head here is, when you go get this loan, you're going to have to get an appraisal. And if the appraisal is lower than what you're buying the house for, of course, you should negotiate the price. And it's very common for people to lower the price, because if it didn't appraise for you, it probably won't appraise for the next person. But if you're buying something for $100 and it appraised for $95, please don't pay $100 for it unless, you know that there's gold bullion in the property. Because, now if you're getting an 80% loan from the bank, it's going to be 80% based on 95. And then you're going to have to put up the $5,000 difference on top of that. So you're going to have an appraisal contingency, a financing contingency when you buy properties. Make sure your financing contingency, you pay attention to what you put in that contract. Because if it says that you have a mortgage commitment date as of a certain date, that's when you're on the hook or off the hook. So what that means is plenty of people go around and get pre-approvals from banks all the time. And a pre-approval isn't worth what the piece of paper that you get it on. Now, when you get a pre-approval, after you get that pre-approval and you put a property under contract, they are actually going to ask you for all your documents, your W-2s, your self-employment, all this other stuff. And then when you give them that stuff, they're going to give you a commitment to the loan. So you have a certain period of time to get a commitment to the loan, or tell your seller, I don't have a commitment, and extend it, that time period, or back out of the deal. If you go past that commitment period, then that contingency for financing is gone and you can lose your deposit. So it's very important when putting in a financing contingency that you do that. But I'm going to leave it here. I wanted you guys to learn about the normal, traditional, conventional ways to finance property with 30-year mortgage in the U.S. You can do it foreign. You can do it with these DSCRs. You can do it refinancing using the Burr method. And please check out my other podcast where I tell you how to raise private money, which has nothing to do with the banks, and how to use the Burr method, which I think is the most powerful method of all the methods in real estate. So thank you for watching this episode, and I hope you enjoyed it, and we'll talk to you soon. Bye.